I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWBF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca. He invented the Inc. Canadian Insider Index, which is used by the Horizons Canada Insider Index ETF, a 2017 and 18 Fund Data Fund Grade A Plus award winner. His website, CanadianInsider.com. Welcome back to the show, Ted.
Well, thanks for having me back, Jim.
Ted, CMHC is launching an investigation or an inquiry into home equity loans, popularly known as HELOCs. They want to know how much are Canadians taking out of their homes. Are they paying back the money? Are they just paying interest? What happens if the Canadian housing market falls so far that you've taken out more loans than the house is worth? Is this a good idea, or is this another case of CMHC investigating the horse, whereas the horse has already bolted down the road and has disappeared over the horizon?
Well, that's right, Jim. I think this is a typical example of a government reaction as opposed to proaction. And I'm a little, surprised. Maybe I'm not so surprised that CMHC doesn't already have a handle on this, given that their role in backstopping hundreds of millions of dollars of mortgages every year, billions of dollars. So the fact that they're just looking at it now is probably a bit of a sense of concern. But look, there's been a lot of anxiety in the capital markets about Canadian housing with respect to have we gone too far? Are the lenders overvalued? Are they ready for a big fall? And we're certainly seeing a lot of short sellers come into the market and short Canadian companies that are involved in servicing both mortgages and these types of home equity loan lines of credit that the CMHC now appears to be investigating. So we will see who is right in all of this, Jim, whether it's the short sellers who seem to think they smell blood here, or whether it's the investors who continue to hold on to some of these investments. And we've got a very interesting situation lined up. We put out our a report every 2 weeks on short selling. It's available on Canadian Insider. In the latest one, we look at this very this very corner of the market, because we've seen a big uptick in short selling in a lender called Equitable Group. Now, they're a chartered bank. They're one of the smaller ones. Their market cap is about $1.2 billion, and to put that in perspective, the National Bank, which is the smallest of the big six, is $21 billion. But we've seen a big uptick in short selling, and Equitable actually releases its results after our interview. So we'll see. We'll get our first look, I guess, to see who's winning this contest between the shorts and the longs on Equitable Group and Canadian Housing, because Equitable Group is a lender into housing and into the consumer tied to housing. So it will be very interesting to see what happens here. I would also note that so far in earnings season, we have seen some shaky stock performances from some of these lenders after their results. First National, which is a prime mortgage lender, it disappointed the market, and it fell almost 6% on May 1st after its results. So that was I think maybe foreshadowing some of the other stocks in the market that are involved in lending, but we'll have to see how Equitable Group does on Thursday night.
Now, this just brought a thought to me here. Is this one of the dangers of when you take your company public? Is, yes, you get a nice infusion of cash with the initial shares, but then people can start shorting you. And I noticed the crash in Bitcoin, which happened the day after my birthday 2 years ago, so I kind of remember when it peaked. And it happened when it was allowed to be traded on the Chicago Mercantile Exchange. In other words, you could start shorting it. Is that a problem that maybe companies don't look at, as that people may be eyeing you not as something to invest in, but to take advantage of?
I don't think so in general. I think that short sellers, if it's done legitimately, and I mean that by actually borrowing the stock, not to get too technical, but in Canada, when you short a stock, you are supposed to go and deliver that stock to the person you sold it to. If you're going to be a seller, there's a buyer on the other side. The buyer wants that stock certificate, and you've got to deliver that. So the way you deliver that is you get to go out and borrow it. And it's been interesting in the marijuana space. In fact, this has been a source of revenue for people who've invested in the big marijuana ETF, because I believe that the company lends out some of those shares to short sellers, which has allowed this marijuana ETF to actually declare dividends, which they would not be able to do without the short sellers. So, there's pros and cons in terms of short selling. The argument is pro and against, but in general, I think if you hear of a company bemoaning its problems are due to short sellers, I think that's probably more an excuse than a reason.
Germany banned short selling. Was that a good idea?
Well, I'm not familiar with their regulations, but in general, I do not think it's a good idea, because it just allows even more and more speculation. And when you look at Bitcoin, I mean, it was a bubble at that point, and perhaps if there had been a way to short Bitcoin earlier, it may not have gotten out of control. But look, that's all conjecture. Bitcoin itself is not something that is amenable to shorting, and that's just the way it's structured, and that's fine. There's a few equities in the market that you can look at, but still not a lot. We never really got to the point in the Bitcoin development, industry development, where you had a lot of sort of blue chip type, very large liquid companies involved with cryptocurrencies. We may still get there, because I still think it's early days in cryptocurrency and blockchain. I believe there is a path for development in that industry. It's just taking a while now that we've had the blow off from 2 years ago, right around your birthday, Jim. So it wasn't a great gift to the Bitcoin industry, but it will evolve, and we're starting to see a bit of a bounce back here, and we could be in for some interesting times ahead, I think.
We'll talk a little more about cryptos when we return.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market, with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. I'm speaking with Ted Dixon. Ted, I had a theory that Bitcoin became so much more popular than gold because millennials understand computers. They have no idea about stuff that comes out of the ground. Is somebody trying to take advantage of that right now?
Well, look, that's an interesting question, because there's an investment company called Grayscale that has just launched a fairly controversial advertisement campaign trying to get people to drop gold in favor Bitcoin. Now, I believe Grayscale runs the Grayscale Bitcoin Trust in the United States, so obviously we know where they're coming from. But it's interesting. They've just launched this in May, and they've had quite a reaction to it, which I think was intended. Whereas it hasn't just been a one-sided debate. Yes, let's all drop gold and rush into Bitcoin. We've had some interesting responses. Now, the whole premise of their pitch is that gold's heavy, it's clunky, but look at Bitcoin. It's electric. It's crypto. It's light. It's modern. You don't have to push it around in a shopping cart if you're super rich. So it's interesting. But of course they've had some counter arguments come up pretty quickly, and one of the counter arguments, of course, is that unfortunately for Bitcoin, you need to have a power supply, and if lights go out, your cryptocurrency isn't going to do you much good, whereas, gold, you will have it there in your hand. So I think at the end of the day, I think this is actually a good development for both, that someone has come out and tried to shake things up, because there's room for both. I think when you look at the arguments on both sides, there's some good arguments on both sides, but, in favor of cryptocurrencies as a alternate vehicle, and gold as well. There's very good arguments, and they're kind of complementary when you think about it, because yes, gold is kind of hard to use in terms of transactions, and a cryptocurrency is more suitable for that. But cryptocurrencies are not a great source of safety when if there were an upheaval or war. If you're in an area, we're not all blessed like we are in Canada, where we have a nice peaceful society and no threat, at least not right now, of any civil unrest. So in a more war-torn or risky environment, your cryptocurrency may not be accessible. So there's arguments for both, and I think it's a very interesting development, and because over the next few years, I really believe that the current monetary system is going to come under a lot of scrutiny, and at some point people will start looking for alternatives. So it's actually very good, I think, maybe to start this debate now, and let's hope we can keep it healthy and not a winner take all type of debate and argument that you often see in social media. And in fact, I would think that Grayscale kind of had it in mind that to get the ball rolling here with this advertisement, Drop Gold, I think is what they've called it, and it has got a good discussion going. So in that sense, bravo for them to sort of kick things off. Now it's back over to those in the mining industry and the gold industry to counter those arguments. So let's turn up the temperature a bit and maybe we'll get the public's attention who aren't investing in either of those. I mean, we have to make the pie bigger for both of those asset classes if we're going to really interest people in looking at alternatives and looking at, and start questioning the status quo, which really, as a number of your guests have explained over the past few weeks, and I really like that interview you did with Tim Wood on This Week in Money last week. There's the sort of the status quo is really, really looking tired here, and it really seems to be, in terms of the monetary system, we're in the home stretch here before I think we got to start something new. But how much longer we have to go, of course, is still an open-ended question.
May 7th, China brought in a law banning the mining of cryptocurrencies. Of course, the question is, like so many laws in China, will they enforce it?
Right, and the mining of cryptocurrencies is only one aspect of the whole industry, and in that sense, the fewer mines that there are of these cryptocurrencies, the more valuable they would become, right? Because you're not creating as many. So I wouldn't get too fussed about that.
We'll have more with Ted Dixon right after this.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ted Dixon. Ted, President Trump seems to be upset with the trade talks with China. Friday, the deadline to impose a 25% tariff on a large range of Chinese goods. China saying, well, we're going to look at ways to retaliate if that happens. What's that going to do to the equity markets and investments?
Well, everybody who's active in the markets is certainly keeping an eye on their Twitter feed to see what the latest pronouncements are from the White House and from that matter from China. They're seem to be quite engaged in responding to Mr. Trump, which is quite interesting in itself. So we put out a piece. We put out a weekly newsletter. It's free. It's called Insights on CanadianInsider.com. We talk a little bit about, is China going to essentially save the world again through stimulus in response to these trade threats? Now, what's really interesting, Jim, is that in the past 2 years, the Fed has raised interest rates 6 times. And I was just reading on Reuters today that since early 2018, the People's Bank of China has cut its reserve requirement ratio 5 times. So you've had a Fed tightening and you've had China loosening. Now you understand why Donald Trump is ranting and raving against the Fed, because he doesn't want China to have any advantage in these negotiations. And on the monetary side, China has been preparing for battle here, which is, it's quite interesting. So what's happened so far this week is actually quite surprising. It surprised me because as we've been writing, our insider sentiment indicators aren't very upbeat right now. If anything, they look a lot like last year, which was, bracing for a correction. But just in the last few days, every day this week, we've seen the Canadian Insider Index, which is a Canadian mid-cap oriented index, outperform the broad U.S. big markets. Now, this has not happened, even for like 3 days in a row, for quite some time. So that's very interesting. And this is in the middle of this trade war. I'm very surprised at this. And I think it's something that your listeners might want to keep an eye on, because it could be signaling, and I think it's still too early to tell, but it could be signaling that China's attempts to reflate its economy, to stimulate the economy, it may be having some effect here, and these may be the early signs of that. Now, how bad the trade situation gets is anybody's guess. If we have the sort of nuclear trade war scenario, well then that will throw more than just a wet blanket on any growth reacceleration. But let's just say things keep muddling along, the base case where there's an extension, maybe there's a few tariffs are slapped on here and a few tariffs there. But we'll see. We'll have to see how that plays out. What it suggests to me, though, is that there is a lot more going on than just a trade war here. The U.S. economy looks like it may be starting to slow a bit. We've had a turn in the jobless claims. They disappointed today. The 4-week moving average has bounced hard off of its multi-decade low. Now, maybe it was due for that anyways. But so there's some interesting dynamics at work here. Another pair that your listeners might want to keep an eye on is the Australian dollar versus the Canadian dollar. The Canadian dollar has been outperforming the Australian dollar quite a bit recently. If that changes, it would suggest that China is maybe regaining some relative economic momentum against the United States. But we're not there yet. But it's certainly something to keep your eye on.
Bob Hoy, our historic market watchdog, said something interesting about interest rates. He said when they're going up, that means good times. When you start bringing them down, it actually may be one of the causes of recession. Instead of a reaction to it, it may be actually a causal factor, because it happens every time when things come down. It happens during a time when interest rates are coming down.
Right. Well, if interest rates are coming down in the market, there's less there's less demand for borrowing funds. So that would suggest less economic activity, and either through demand, people not wanting to borrow, or you could have lenders just not lending as much, and that would restrict economic activity. So, I think Bob is right in when he says, when you see interest rates going down, don't start cheering that means good times are on the way. No, it usually means the opposite. Now, usually, under the circumstances where you don't have central banks manipulating fixed income markets around the world, we're in a completely different era now. We're in this fixed market, central bank trickery situation where they're trying to manipulate markets. So a lot of these signals that you could rely on, a lot of these interpretations of interest rates, it's a lot trickier now. Let's just put it that way.
Also, something that I was thinking about when it comes to interest rates, it's nice to see the value of real estate fall if you're looking to buy a home, but in that kind of market, banks are less likely to give you a mortgage because they're worried with a falling value market, they might not get their money back if they have to foreclose. So while the homes are more affordable, you can't get a loan to buy one.
Well, that's right. And particularly if homes are falling because everybody's losing their job, you may not even have a job to buy one. So that's unfortunately the reality of markets adjusting to economic situations, right? Because if fewer people can afford to buy a home or get credit, the price has to come down. So, will we get to that point in Canada? We're certainly not there yet. And that's why, I think there is a housing correction of sorts going on in the major cities here in Canada. But, the housing market in Canada is bigger than Vancouver and Toronto, and some of these areas just never experienced, some areas, prairies, Eastern Canada, never experienced the type of run-ups that we saw. Now, of course, Toronto and Vancouver are huge markets. They're very important markets, but they're not the only markets in Canada. So we will have to see I think perhaps the negativity associated with Toronto and Vancouver, particularly Toronto, is probably overstated in the media just because of its size as a media city. And most of the national media organizations are based there. So when their cities' real estate market starts to feel some pain, you hear about it. But if Montreal, Montreal was starting to boom just last year. I haven't checked the recent numbers in Montreal, but you didn't hear a lot about the boom in the Montreal real estate market. But it was happening even as Toronto and Vancouver were languishing. So, there's a lot of different markets, and as they say in real estate, Jim, everything's local, right? So I don't see a systematic collapse in the Canadian real estate market, but doesn't mean we couldn't have continued corrections in Vancouver or Toronto for that matter. But I don't think it's right to throw the whole country into that. But it will show up in the stats, of course, and in the averages. But doesn't mean a home buyer in Winnipeg is facing the same kind of situation as a home buyer in Vancouver.
Well, I did see that the applications for building permits were higher than expected. Is that good news?
Well, it's always good news when if you're a home buyer, I think, to hear that. But these move around, seasonality and the like. There's a permit, but then do they actually have the shovels in the ground right away? So there's all those factors that have to get worked in. But look, let's see how these companies report. Home Capital today, we've seen Home Capital reported sort of this week, and they came in pretty much in line, maybe a tad softer than people were hoping, but didn't seem to me anything dramatic. Equitables reporting tonight. First National disappointed. We've got the banks were mixed bag. So no, nothing. Certainly no screaming boom going on in Canada for sure. But are we at a cross-country real estate bust? Well, you've had a number of guests on that are more familiar with the market than I am. But in terms of the stocks that we've seen, some of them have had nice runs. Maybe they're due for a break in any event, and people will just use kind of lackluster results as a reason to sell them and see a correction here, or maybe they'll be viewed as a relative safe haven if things get really nutty on some of the other economic fronts. So we'll have to see how it plays out, but I don't quite see a doomsday scenario at this point across Canada. But let's check. We can revisit that in a few months, Jim, and we'll see if things change.
Ted, anything else you wanted to add to today's show?
Well, I just think we'd have to keep an eye here on what's going on with U.S. insiders in particular, and what's going on with some of the mega cap stocks in the United States. We've written a piece on Canadian Insider. I just posted it today, basically looking at 10 of the big market leaders and how they're ranking on our Inc. Edge process. We want to see the majority of them to be with high rankings. Right now, it's 50-50. We've got 5 of them with good rankings and 5 of them with mediocre or average rankings. So we're going to track that, see how if these large cap heavy hitters such as Microsoft, Amazon, and a few others can hang in, if they can hang in here and keep the market, the U.S. market steady and rising. I really think that you've got to look at those big hitters, because that's where investors have put their money. That's where they put their faith. We call it the boy playbook, the Bernanke, Obama, Yellen playbook, rushing into these large growthy type expensive companies, looking for growth opportunities in big stocks. We'll see if that playbook works here this summer. Right now, we're looking at a 50-50 chance, but take a look at the piece on Canadian Insider. It'll give you a bit more background on it, but certainly those big cap U.S. stocks are something to keep an eye on and going forward here.
Thank you so much, Ted.
Well, thanks for having me back, Jim.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Ted or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.